In this presentation, we will purchase equipment with debt or financing. In other words, we will purchase equipment and finance it and take out a loan in order to purchase the equipment. This type of transaction can be deceptively confusing because there's no set form within QuickBooks to set this up. In other words, this isn't something that happens all the time. Therefore, there's no standard form. We're not writing a check because no cash is involved. Therefore, it can be a little bit confusing to set this transaction up. We will do this within QuickBooks Pro 2020, QuickBooks Desktop 2020. Here we are in our Get Great Guitars file. We currently have the open windows open. You can open the open windows by selecting the view dropdown and choosing the open windows list. We're now going to be going through and recording the purchase of equipment with a loan. As we do so, let's first take a look at the financial statements. We're going to say the drop down up top. We're going to go to the company and financials. We're then going to go to the balance sheet standard. Balance sheet standard, opening that up, changing the dates up top in the customized report at the top left to 01/01/20 to 12/31/20. That's January through December 2020, and OK. Now, what's going to happen here when we record this? What's happening is we're purchasing furniture and equipment. As we do so, we're not expensing it at the time of purchase. We're going to put it on the books as an asset because it's something that's going to be living over a long period of time in accordance with the matching principle, and we will then depreciate it over time, which will be an adjusting entry we'll do at the end of the period. Therefore, it will be an asset account that we want to increase down here. Now, normally when we purchase something, we would basically write a check for it. Cash would go down or something like that, and we would write a check, and the other side then would be the asset increasing. However, we're not going to have the other side be in the checking account because we're going to finance this purchasing process. So where's the other side going to go? Some type of liability account. It's going to be some type of liability down here. We're going to put some type of loan payable that we're going to put on the books. That's what we're going to need to increase. All right, so that's what we need. That's what needs to happen. Let's then go to the Home tab and say, well, what kind of form? Because usually whenever I do something here, I select one of these forms, and then it does what I want, right? It records the transaction for us. However, there's no real set form to set this one up. You might say, well, it's kind of like entering a bill, because we're going to enter a bill which would increase the accounts payable, and then we could put the other side basically to the equipment. But this is a bill, and the account of accounts payable is not a long-term, it's not really a financing or a loan account. It's really a short-term account that we expect to pay off shortly. So although you could do that, it's not really the proper way, and plus you can't really record the interest as easily in accounts payable. So really, we don't want it to go to accounts payable. We don't want to use a bill. We want to set up another account, which is going to be a loan account, which we can basically charge the interest will be involved as we go through the financing process. And of course, the problem here is that although you would think it'd be up in here in the vendor section because we're buying stuff, there's no form that really is going to be tied out to this. If we were paying cash, we could, of course, use a check. But there's no standard form. Why doesn't QuickBooks have a form for this? Well, because it's not a normal type of transaction that happens enough for us to set up a form just for that basic kind of transaction. So that means that these forms here are going to be for anything that happens pretty much regularly, fairly often. And therefore, there's going to be a set form for it to kind of standardize that process and make the data input more easy. If there's no set form, because it's something that doesn't happen as often, it's not a rare trend. It's not like people never buy equipment. It's going to happen, of course, but it's not something that happens every day through the transaction. So there's not a form for it because it's not something that's going to happen on a regular basis in the course of business. So what happens then is the default then is usually goes to then what we would think of as a journal entry. Now, instead of using journal entries, we could use registers, which in essence is a journal entry as well. So the way you want to think about it is there a form that we can use here to do the data input? If not, then we go to the journal entry, and you can think of registers as being similar to journal entries here. If you know debits and credits and you would rather just use a journal entry, then you can go to the company tab, and you can go to the make journal entry here, and you can then enter the debits and credits in this format. I'm going to use the registers here, which is basically the same thing, but we're going to be trying to use an up and down type method in order to do it. So I'm going to close this back out. I'm going to go back into the balance sheet. Notice that if we use the register, we have to choose which register we want to use. We could use either one because they're both balance sheet accounts. So we could use the loan payable register, or we could use the equipment register, furniture and equipment. I would prefer to use the equipment. I think that makes more sense. Most people, would say, okay, the equipment's going to go up, the furniture's going to go up because I bought more of it. So let's go to the furniture and equipment register. To do that, I'm going to go to the lists dropdown. I'm going to go to the chart of accounts. I'm going to look for the furniture and equipment, which is here. I'm going to open up the register by simply double clicking on it. It'll open up a register that looks a lot like the check register that we're used to using, but this one, we're not in the check register, we're in the furniture and equipment. That means that if there's an increase, we're increasing furniture and equipment. If there's a decrease, we're decreasing the furniture and equipment, and then we'll put the other side wherever it should go. That'll be the loan. So I'm going to enter then this as of 02/28. That's what we want, 02/28/2020. Then we're going to say that it's going to be Office Depot that we're purchasing from. We already have that vendor set up. Make sure that we are in the increase side. So it will be an increase, and we're going to say it's a $5,000 increase. Now, what is the second account we should have? It should be some type of loan account. When we think about the loans, remember that we could group all the loans together and then basically break out the detail in some way to think about the different loans that we have, or we can make multiple different loan accounts. So I'm going to actually group them together here. We'll have another course that we go into basically how do we account for the loans a bit more, or the different options, because there's really are a bunch of different options you can think about on how you want to group your loans. If you have a lot of loans, then you might want to group each loan separately. And then you have to think about, should I be breaking out the short-term and long-term portion of the loan? We'll talk about the short-term and long-term portion a bit more as we consider the adjusting entries. So your basic options are, do you want to have a separate loan account for each new loan that you have? Or do you want to group them all together in one loan account? And then you have a subsidiary kind of ledger breaking out the detail of the different types of loans that you have. We're going to put, for the example problem here, the two loans, because we already have one out. If I go to the balance sheet, for example, we already have loans out here in the loan payable. So that already includes a loan that's in it. We can put another loan to it and then just simply say that's my loans payable. It includes multiple loans, and then have the detail broken out in some other fashion. That's what we're going to do here. We're then going to go back to the furniture and equipment. So we're going to pick up the loans payable, which is going to be a liability. Notice it's defaulting down here to the expenses. We want to go to a liability account, which is going to be the loans payable. Here it is. Or we could type in loan payable, tab, and then we could put a memo, purchase of equipment. We probably should. I'm not going to put one here. And then we could say record it. What's this going to do? Well, we're in the furniture and equipment. Therefore, it's going to increase furniture and equipment by the $5,000. The other side then go into loan payable, which will actually increase the loan payable. So if we go back to the balance sheet, let's see if that is indeed what has happened. Back to the balance sheet. We see that going back up, we got the furniture and equipment, which is here at the 103. If I double click on the 103, we see the 5,000. So there's the 5,000. Double clicking on that 5,000, we get back to our register. Notice this register is in essence a journal entry, as you can see here. Double clicking on that journal entry, you'll get to your debit and credit screen. There's the journal entry. Closing this back out, closing this back out. Also note you'll see the reference to the journal entry here in the type. Closing this back out, then other side, go into the payable account. Scrolling down, we have the loan payable at the 74,878. Double clicking on that, we then have the detail. Here's the journal entry, here's the Office Depot, there's the furniture being the split or other account. Double clicking on that 5,000, then we see the ledger. And if I double click on this, we're going to see the journal entry once again. Closing this back out, closing this back out, closing this back out, closing this back out. You'll note there's no effect on the profit and loss statement at this point in time because we haven't used the furniture. We're going to record the cost over the life of the furniture with depreciation. We'll see that in the adjusting entry processes at the end of the month. Let's take a look at our trial balance just to get a review of where we stand at this point. We're going to go to the reports drop down. We're going to go to the accounting and taxes and then the trial balance, changing the dates up top from 01/01/20 to 12/31/20. Here is our trial balance. You can review these numbers and see if they line up. If they don't, you can go back in and try to fix it, which is good practice, or you can go to the backup files that we will be providing, restore the backup file to the point in the problem that we are working, and you can just simply push forward from there if you so choose.